From New York City for our viewers worldwide, I'm Matt Miller alongside Emily Grafeo. Bloomberg Real Yield starts right now. Coming up, U.S. producer prices come in hotter than expected, pointing to lingering inflation pressures. JPMorgan boss Jamie Dimon warns people are making some dumb decisions. And a new credit blow-up across the pond leaves global Wall Street chasing billions. We begin, though, with the big issue, the outlook for the U.S. economy.
I don't think that we can underestimate just how important the wealth effect has been allowing this overall economy to levitate.
We don't have micro stability.
The issue, of course, is how are we doing in the horse race between AI job creation and job destruction?
I'm really nervous about the economy for the next few months.
I don't know that I have the imagination fully to guess where this economy is going to go.
Investors are recognizing they can go into bonds. There is yield there. It is the counterbalance to risk.
So you're seeing a little bit of a flight to safety. We're still facing that lower break-even pace of employment.
The labor market has been somewhat stronger than people had thought.
The Fed is not going forward with an easing bias.
We think in an environment where the Fed maybe still has 1 to 2 rate cuts ahead of it.
If they're cutting rates in the spring, that means something very bad has happened between now and then.
All right, well, it's month end. Take a look at how Treasuries have performed. This is an index of the U.S. Treasuries. Best month since last year, with U.S. Treasuries returning about 1.5%, and that U.S. 10-year yield moving about 25 basis points lower for the month of February as investors fear AI disruption, maybe some fears in the private credit markets. They're using Treasuries as a safe haven. You heard Wall Street talking about economic uncertainty. We're seeing here that bid into the Treasuries. Now, meantime, the Fed has its eyes on inflation. Bloomberg's Mike McKee sat down with Chicago Fed President Austin Goolsbee earlier this week.
I'm a little more concerned about inflation right now because I think the job market is pretty steady. I think growth is pretty steady. I think there's some promising stuff in the inflation reports, but there's also some warning signs. So, as I say, I'm not hawkish about rates. I'm pretty optimistic that we can get rates down further, multiple cuts in 2026, as long as we see the progress on inflation.
All right, let's dig into all of this with our macro roundtable. Subadra Rajappa, head of research at SocGen Americas, as well as Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. Subadra, we'll start with you. What's your take on the driver here in the Treasuries move?
It's actually a combination of things. I don't think it's one clear catalyst. Geopolitics, I think, is an important factor. The Saspocalypse, as it's called, is another factor. I think that people are concerned from a risk sentiment that things might be changing quite dramatically. And if you look at some of the other metrics and the details in some of the data, it might be a little bit more troubling, especially the implications of AI on employment. I think that the market is looking for direction on where to go from here, and the path of least resistance seems to be towards lower yields, especially at a time when equity markets are selling off.
And we did get PPI, Kelsey, in higher than expected. Does that mean that the Fed is going to have to rethink the cutting narrative?
I don't think that we're at a point where the Fed is rethinking their narrative based on the PPI data, although I will say we are in a bit of an unusual spot where PPI was hotter, which means PCE, the Fed's preferred measure, is also going to be hotter. And we're going to be in this weird period where PCE, the Fed's preferred measure, is running a little bit hotter than CPI, which is a little unusual. But taking a step back from all of those nitty-gritty details, in general, where we have our highest conviction right now is continued disinflation. And that's coming from the cyclical parts of inflation, shelter and wages, where we still see a fair bit of disinflation in the pipeline. And that's what's allowing the Fed to remain comfortable here, even though inflation still does remain modestly above their target.
Subadra, I want to ask you about where you see the direction of yields, because you said that the bar is really high for a rally in bonds. Yep. So what needs to happen in the macro to keep that rally sustained?
So I did think that kind of breaking through that 4% threshold will be difficult, but then we kind of blew through it today. If you look at some of the metrics that I was tracking in our weekly that we published yesterday, you look at the call skews versus put skews, the market seems to be concerned about a move lower in yields. Either people are hedging for that kind of scenario, or they're positioning for that kind of scenario where yields could kind of break through that 4% level. And that's exactly what we had happen this morning. It could be technical reasons. You're looking at month end, et cetera. But then overall, I mean, the concern seems to me that towards lower yields, especially in an environment where inflation is hot and sticky. If the front end is pegged and the Fed does not move in the first half, any sort of weakness in the data is going to manifest itself in the back end of the yield curve. The safe haven bid is going to come into the back end of the yield curve.
What if there's any more tariff disruptions? We've gotten a lot of news, not clear yet what the ultimate new rate of tariffs will be after the IEEPA ruling. But if we were to see increased tariffs, would we see inflationary pressures and therefore yields climbing, at least on the back end?
So there are many dimensions to the tariff story. One is the inflation side of the equation. To me, I feel like we're actually at peak uncertainty on tariffs, not the other way around. Because my expectation coming into the year is that by mid-year, we would be well past the peak tariff concerns. One is inflation, which I think is a key concern. The other is debt and deficits. Right? A good portion of the projections of the CBO over the next 10 years, if you look at the amount of revenues that the CBO was anticipating from the tariffs, if that revenue, if there's any sort of volatility in that revenue, that I think is going to be a source of volatility and could potentially lead to higher term premiums, higher coupon issuance sizes. So that's something that I'm watching very closely.
A year on, I guess Doge didn't actually end up taking $1 or $2 trillion of costs out of the federal government. Why, Kelsey, do you see disinflation? I mean, there's so many drivers, I would imagine, of inflation. Not only the tariffs, and I know there are question marks there, but President Trump seems set on 10% now, 15% as soon as possible. Plus, we're going to get more refunds, we're told, tax refunds than we did last year. Obviously, U.S. consumers spend that money when we get it on, tariffed goods. And it just seems like everything is pointing to, I mean, if we get $2,000 stimmy checks, that'll be off to the races, right?
Yeah, so a couple thoughts there. One, as it relates to stimulus checks funded by tariff refunds, I think the probability of that has come down a lot because of the IEEPA ruling. I do think that the tax refunds are a modest boost to consumers, but I would highlight the fact that most surveys show that the most likely thing that consumers are going to do with those tax refunds is save it or pay down debt. So I would say that
U.S. consumers going to be saving money, huh?
Well, if you look at the more recent savings data through December in the last personal income and spending report, the savings rate is actually down to its lowest level in about 3 years, and real personal disposable income is also slowing a lot. So I think actually what the consumer is going to need to do is use a little bit of that refund to replenish. Now, more broadly, why do we have conviction around disinflation? It comes down to really two key categories. It's shelter inflation and wages. I'll just give you two of my leading examples on that. One, on the shelter inflation side, one of the things we look at is primary rental data. That primary rental data is showing still very modest, low increases in rent relative to the last few years. And then on the wage side, one of my favorite indicators is the Indeed wage tracker. Tends to lead overall wages by a few months, and that is actually at a new cycle low. And so I think we're still in an environment where, in general, the person looking for labor has a lower position than the person negotiating position than they did a few years ago. Not a lot of bargaining power as it relates to wages, and so that environment is still intact.
Subadra, what do you think? Because I've noticed a couple of things. Software hiring is still up 11%, even though, Jack and Block are cutting, 4,000 jobs. The average job seeker still wants to work from home, so they must have some kind of leverage. And then there's so much money being spent. I mean, hundreds and hundreds of billions of dollars on these data centers. Everything to me seems like it's poised to drive inflation higher, even if wages aren't growing. And this is the hottest economy in the world, right?
Yeah. And I agree with you. I think that's where I think I differ from Kelsey a little bit. Yeah. I feel like the inflation story still has a lot more to play out. At least in the first half, or maybe 3/4 of the year, you're going to see sticky inflation being the driving factor. If you look at the PCE, the PPI data that we got, and it's going to feed through to PCE in the print that we get next week, we're going to be looking at slightly north of 3% in core PCE. That to me is troubling. There's a lot of sort of very specific sectors, healthcare, airfares, things like that are still very sticky because consumers are continuing to spend. They all have jobs. The economy is extremely resilient. You're looking at a very strong trajectory for GDP growth. The CapEx spending is going to be very, very strong in the first half. As Kelsey was pointing out, you do get some of these refunds that could support the consumer. Maybe that goes into savings. Maybe that goes into consumer spending. And you're looking at overall the job market remaining relatively stable. Yes, are there cracks? Could there be cracks in the system? Yes, but for the most part, we're at or close to full employment.
All right, it takes two sides to make a market, and I guess we have that here. Thank you so much, both of you, for joining us. Subadra, Rajappa from SocGen, Kelsey, Berro from JPMorgan. Up next, global return. MFS collapses in the UK, causing another pain point in credit. We just learned that TPG has 44 million pounds of exposure to MFS. This adds to concerns around software, which are not light. This week in London Marathon's Bruce Richards said the potential default rate in that sector for private credit holdings could reach 15%.
If you're a private equity manager, if you're a private credit manager, and you have less than 10% exposure, I think you're just a market and you're perfectly fine and the market's doing quite well, the overall broader market. Okay. But if you have 23% exposure, which is actually the number for private credit exposure to software companies, you're having a lot of pain right now and you're going to have to deal with a lot of fallout from this.
Unfortunately, we did see this in 05, and 06, and 07, almost the same thing. The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. They're just doing dumb things to create NII or say they're winning in the markets business or something like that.
I'm Matt Miller alongside Emily Grafeo. This is Bloomberg Real Yield. That was clearly Jamie Dimon speaking earlier this week and leads us to our segment called Global Return, where we highlight stories outside of the U.S. Credit fears popping up in the UK now with the collapse of Market Financial Solutions, MFS. Bloomberg just reporting that TPG's total exposure to MFS is $59 million. For more on this, let's get to the London office. Bloomberg's Konstantin Korkulas joins us out of there. So, Konstantin, what do we know about, tell us about MFS. What does this business do and who has exposure?
Right. So MFS is a specialist mortgage firm. It provides finance for things called, mostly things called bridging loans. So these are short-term loans for people who want to sell a property and buy another one. It's a niche area of finance that big banks usually don't get involved in, and then it services. So the way it works is it borrows money from big financial institutions, has a mortgage portfolio, services those loans, and makes some money off that. Now, what happened is this company fell rapidly into administration this week, and we've discovered that major financial institutions have over 2 billion pounds of exposure to this. This includes Barclays, Jefferies, Apollo's secured products arm, Atlas, and as you said, now TPG.
And now, we haven't seen authorities accuse anyone of wrongdoing, but there have been allegations of fraud. Is that right? Who's that coming from? And tell us about what exactly the fraud would potentially be.
That's right. Right. So there have been some very serious allegations of fraud. This comes from two entities within the broader MFS group that went into administration a week ago. And the the allegations are that MFS wasn't paying the interest due into the correct accounts. So there's over 200 million pounds that's gone missing, I would say. And then the second allegation is that that MFS was double pledging collateral. So it was using collateral that was getting from one lender and using that again over and over. So basically, or not over and over, twice. So we have. So according to the legal documents, these lenders estimate or warn that there could be about a 930 million shortfall in resulting from this double pledging. So these are huge sums.
What does it tell us about the broader credit environment? Is it fair to assume that this is potentially suggesting broader credit fears, or right now, is this just a one-off?
I mean, every time we hear about one of these stories, people come out and say it's a one-off. But there's a point at which, I guess, when this becomes a trend. This is we saw similar. We had Trickle or First Brands, which were so yeah. I mean, I think it's a warning sign, definitely, that. And I think investors are going to be taking a close look especially to this specialist mortgage sector.
Right, a warning sign, and certainly one we'll be keeping an eye on. Bloomberg's Konstantin Korkolas, thank you for joining us. Up next, a moment of interest. CoreWeave shares are plunging as spending puts investors on edge. We look at its bond sale this week. This is Real Yield on Bloomberg.
Happy Friday, I'm Nora Melinda. Let's take a look at your midday movers. First up, Paramount Skydance has officially won the fight for Warner Brothers Discovery, agreeing to pay $111 billion, outmaneuvering its rival Netflix after a months-long battle. Netflix bowed out of its $82 billion offer after Warner's board declared Paramount's bid superior. The deal, if approved, gives the Ellison family control of a media empire including 2 Hollywood studios, 2 major news networks, the HBO streaming platform, and dozens of cable networks. Both Netflix and Paramount stocks are higher on the news. Elsewhere, shares of Dell are soaring after the company delivered an outlook for sales of its AI servers that topped expectations, a sign of robust demand for the machines helping fuel the AI data center build-out. The company said it expects to generate about $50 billion in AI server revenue in the current fiscal year, and has a record backlog of $43 billion. And finally, CoreWeave is tumbling for double-digit losses after reporting a bigger than expected loss. The company's loss widened to 89 cents per share in the fourth quarter. That was against expectations for a loss of roughly 72 cents per share. CoreWeave also said that 2026 capital spending will be $30 to $35 billion, a larger figure than analysts had initially anticipated. This all fueling concerns about whether the company is overspending on infrastructure. Those are your midday movers. I'm Nora Melinda.
Speaking of CoreWeave, it is this week's moment of interest, a key event that caught our eye this week. CoreWeave is looking to raise $8.5 billion to help finance a build-out of cloud computing capacity for Meta. The loan would be supported by Meta's blue-chip profile and is expected to result in an investment-grade rating and lower borrowing costs for CoreWeave. Bloomberg's Bailey Lipschultz joins us now for more on this story. And although this is an interest rate focused show, the shares, I noticed, of CoreWeave took a hit on this. What's the story?
Well, stock's down today after earnings. They're going to have to spend and keep spending. Obviously, when you're in the neo cloud space, as CoreWeave is, money comes in and then immediately gets kind of earmarked to be spent. So when you look at our story from earlier in the week around that $8.5 billion loan, that was predicated on Meta deals plural. So basically using that as a way to help them borrow capital to then essentially in turn build out those offerings. Obviously, when you look at CoreWeave and kind of the entire neo cloud data center space, a lot of big deals, a lot of different mechanisms being used to raise that cash.
So did you get a sense when you were reporting this out that the momentum that Wall Street basically has to fund data center and hyperscaler spending is starting to cool, or are we going to see way more of these stories, Bailey?
It's hard to really say definitively because we've seen SPVs being used to fund some of these things. Obviously, special purpose vehicles where different companies are kind of using different mechanisms. This one is relatively novel, though, because they're using Meta's name and Meta's kind of projects to help backstop that and help bring down those costs. Again, still hasn't priced. It's expected to close next month. So it does seem like this is still a saga or an event that's going to continue to unfold, because you need to continue to build out data centers. You need these hyperscalers and these neoclouds need to continue to put money to work.
Yeah, talk to us about just kind of the details of how this bond deal is getting done, because you write that CoreWeave is expected to burn cash for at least 18 months, and yet they have the backing of Meta, so they're going to be getting an investment grade rating, essentially, because they have Meta carrying this.
Pretty much that's the view. And when you look at it, according to our reporting, you have the two big Meta contracts. So one worth up to $14.2 billion, and now they're valued at more than $5 billion. So you take those two projects, call them $19 billion, just for easy math, and then you turn around and say, well, we're going to take on a loan, if you're CoreWeave, about half of that value. So you're using that to help prop up this loan. The expectation is that this will come in and potentially, as you mentioned, get an investment grade rating, which would make the loan much cheaper than what CoreWeave would get if it were to go to the regular kind of junk market. But obviously, when you look at the entire ecosystem of building these out, there's a lot of money that needs to be borrowed from somewhere. And that's obviously, we're even seeing that with an OpenAI fundraising round that's going to bring in money from a number of those hyperscalers.
Right, OpenAI getting, $110 billion in its funding round, values it at like 730, which still seems kind of low. CoreWeave is going to spend a lot more money, though, than investors expected. Or I should say a little more, right? $35 billion instead of $30 billion in CapEx was the forecast from the earnings this morning. Investors, why would investors punish them for this? It seems like what you would want to do, right? When Facebook does it, everyone's so happy.
Well, you look at that, but then you also look at the fact that their operating income target at the midpoint was about, according to BI, less than half of consensus. So the underlying business maybe not living up to expectations. And so when you layer that on top of the fact that they're going to burn more money than expected, the whole conversation comes back to one of the most hotly debated stocks in the market, point blank, and a kind of stack, if you will, of debt that at some point is going to hit out differently, whether you're an an equity holder or you're someone who's backing some of these other vehicles.
All right, Bailey, great to have you on the program. Bloomberg's Bailey Lipschultz.
Up next, the auction block. Abbott Labs leading with high grade with one of the biggest sales of 2026. We talk issuance and credit next. This is Real Yield on Bloomberg Television. I'm Emily Grafeo with Matt Miller. This is Bloomberg Real Yield. Time now for the auction block, where we highlight the big credit issuance of the week. We start with U.S. high grade. Abbott Labs posting a massive $20 billion sale to lead the week. You also saw names like AbbVie and AstraZeneca drive sales to $64 billion. When you look at the month, we close it out with over $190 billion in sales, just shy of the 2024 February record of $198 billion. Bank of America forecasts IG issuance will jump to $240 billion in March, which would make it the fourth busiest ever if sales hit that level. And in U.S. high yield, we saw strong demand to close the month, with Thursday seeing its most supply in 5 weeks. It's the second straight month with about $30 billion of issuance and the busiest February since 2021. And of course, a big story we've been following this week, growing anxiety around private credit funds tied to software. Strategic Value Partners Victor Khosla joined Bloomberg this week, saying he's seen issues building even before software became a concern.
Over the course of even the last 18 months, 24 months, underneath the surface, it is really wobbly. We have 6% default rates in high yield, Moody's numbers, elevated numbers for the last 2 years. So even before we are hitting this current wave of issues with software and what it'll do, even before that, there was just underneath the surface a lot of stuff going on. You don't want to overdo kind of what happens if there are credit problems in terms of broader systemic risk. I do think, though, software is a big stick. You know, the credit market has had all these sticks being dropped on it, and one day it'll really buckle. One thing I would walk away with today, the tail risk in credit is fat. Wow. This is a fat tail risk now. It's no longer a normal tail risk. And something like software, the How big a problem it is, I don't think we even quite know yet.
Wow. Let's dig into all of that now with our credit roundtable. Meghan Graper, Global Head of Debt Capital Markets at Barclays, is here with us on the set, as well as Maureen O'Connor, Global Head of High Grade Debt Syndicate at Wells Fargo. Meghan, let me start with you. What's your response to that fat tail risk comment?
I mean, there are definitely cross currents at play here, and we've seen heightened volatility. But I think what we heard from Victor was really more down the credit spectrum. I think where Maureen and I reside in investment grade, what's lurking under that surface is actually a large anchor of incredibly positive technicals. And that is coupon income that continues to get reinvested into investment grade. There's $1.4 trillion of coupon income and redemptions that are helping to underpin a bid for the upper echelon of the credit markets, alongside of 46% increase in inflows from new money alongside of that. So I would say technicals are doing the heavy lift for us in investment grade, and we've been the beneficiary and frankly seeing a record start to the year, both in January and February as a result.
Well, I mean, there's a ton of demand, right, Maureen? And I was looking at IG credit spreads because I keep wondering why they don't get wider. They're widening out a little bit, but not a lot, actually. This is high yield tech spreads. Obviously, they're blowing out. But if you look at IG spreads, and Daniel Curtis, our London-based producer, put out a chart in his morning note this morning on IG spreads showing that they really haven't blown out that much.
And that's absolutely correct. And I think it dovetails off of what Meghan was just talking about around the demand technicals that have supported our market. Investment grade as an asset class does tend to be better insulated than most against some of these, broader market gyrations like we're experiencing today. Over the last few weeks, though, we have seen some widening pressure in spreads. We're about 12 basis points off of the multi-decade tights that we reached back in the end of January.
This is the right chart now, yeah.
That's the right chart. So we've seen a modest widening pressure, but under the surface, though, there is some sector dispersions that are happening that's quite interesting. So you have, utilities and pharma and energy and, consumer non-cyclical names that have outperformed here in this widening. And then you have AI-exposed sectors, obviously software, business services, some sleeves of the insurance space, and clearly in the BDC sector, you're seeing spreads come under more material pressure. So I think, real bottoms-up credit work and, and credit selection is going to be paramount this year, not just in terms of driving returns, but also in terms of just insulating against losses. So it's, more than meets the eye in terms of what's happening here in investment grade as far as spread pressure is concerned.
Maureen, how does that impact how you're thinking about issuance here? Are we going to see perhaps some of these hyperscalers maybe starting to pull back in terms of issuance because we've just seen so much already to start the year?
I think we expect it to be a very busy year from the hyperscalers. If you count some of the non-dollar exercises that have happened already this year, we've already had about $55 billion just from the big five. There's more to come. I mean, amongst that group, there is a CapEx budget that's over $600 billion, obviously exceeds free cash flow. Going to have to find a channel to finance that, and investment grade is obviously the deepest capital market there is for this paper. So we do expect it to be busy this year. I do think, though, issuers are inclined to kind of front load some of their needs. CapEx has been a little bit of a moving target in recent years, so I think borrowers are keen to kind of get those first dollars as they can. But we do experience perhaps a little bit of isolated periods of market saturation when you see some of these large deals hit the market. But it does get digested pretty readily, and most of these names are these are the highest quality, lowest net debt, highest rated names in our market. So there's ample appetite from the insurance companies, pension funds, ETFs, and mutual funds that have sleeves to put this paper.
Meghan, what are you seeing when it comes to demand specifically from investors for these data center related deals? Are they starting to cool off, or are they still very hungry to kind of buy up this debt?
Yeah,
AI.
Yeah, I don't think it's one size fits all. I think there is, to Maureen's point, a decent amount of credit selection that's playing out. But at the end of the day, I think the actual needs that we see absorbed by the public markets are going to be incredibly manageable in the context of the scale of the market. I mean, you've got an $8 trillion market. At Barclays, we're calling for about $145 billion of public side debt from hyperscalers specifically. So it's a bit of a drop in the bucket. And I think, frankly, there's so much cash flooding in at the moment. I mean, for as much as we talked about Sell America America last year, it frankly didn't materialize. In fact, that foreign bid grew 5 times faster last year than it did the year before that. The Middle East is contributing to that. I'd say China was up about 13% as well. So there's ample liquidity, both new and existing, I think, to absorb the supply we expect from that subset of borrowers.
What do you think about software, and what's your exposure to that? Because I've noticed if you look at benchmark indexes, not by market cap, but just by makeup, software is like 6 or 7%. But if you look at the BDCs, it's like 23 or 24%.
Yeah, I mean, there's some indirect exposure in investment grade for certain, but a lot of the names you're seeing in the headlines do not have public debt outstanding in the investment grade markets. So there's going to be infrastructure related funding tied to software. I think you're probably going to see the private markets absorb some of that supply. And there's some indirect exposure and certainly cross-pollination between those markets. So we won't be immune to some of the bouts of volatility you see in software, but in terms of direct exposure or outstanding issuance, it's fairly contained.
Why does private credit have so much more exposure than, benchmark indexes or high-grade debt desks at banks? What's the story with software for you?
Well, I think the simple answer is that a lot of these companies are not public companies, right? They're not large cap public companies that have access to the investment grade market. These are smaller middle market loans that are made on a direct lending basis. And so therefore BDC exposure tends to be a little bit heavy. And you can see even within the BDCs, which is where I think we feel the pain probably most notably is in that space. You're seeing, kind of the haves and have-nots play out there as well. Some of the, larger, more diversified names continue to kind of perform okay. Smaller, less diversified names with more tech exposure, more software exposure are the ones coming under more material pressure.
I do want to stay with kind of private markets and this convergence perhaps that's happening between public and private. Are you seeing any borrowers that are coming to the public IG market and then they perhaps need more funding and then they're also turning to private markets to get just more money to fund AI, basically?
Well, I think the digital infrastructure build out is where we're going to see this cross section of markets happen because the numbers are just too large for any one capital market to absorb it all. And it's not just about the private channel. A lot of these, data center deals will have CMBS, ABS solutions, obviously the 4A2 market, the private placement market, the 144A market, the public bond market. All of these channels will be needed to finance, what's obviously a massive CapEx cycle that we're in the middle of. So the answer is to your question is yes. And I think a lot of these solutions will end up kind of crossing public-private markets where you might have a private style execution, but public investors investing. And then likewise, you'll have a public style execution where private investors are investing. So there is definitely a convergence of markets happening here and some non-traditional players that we're seeing enter our market in a more material way.
Meghan, talk about that too. How has the public market kind of been impacted by perhaps now these deals, these borrowers that are coming and they're tapping public, but they're also tapping private? Is it affecting spreads at all?
Well, I think it's part of the reason spreads have remained as contained as they have. I mean, these feel like very complementary pools of liquidity and frankly affording avenues of diversification that are affording borrowers more limited size in public markets and then therefore containing new issue concessions as a result. I mean, the same thematic is true when you think about cross-currency issuance as a diversification play. Many of these borrowers are no longer appealing solely to one market to source liquidity. And we saw that with Alphabet a couple of weeks back, appealing to sterling investors, appealing to euro investors. All of this, I think, akin to what you're seeing in private markets is diversification of funding sources, mitigating price breaks as a result of that, which net means technicals are underpinning and winning out.
All right, Meghan, great to have you here. Thanks so much for joining us. Meghan Graper there from Barclays, Maureen O'Connor from Wells Fargo. Also, fantastic to have you on set with us on Real Yield. If you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the Bloomberg terminal or wherever you get your podcasts. Just want to bring you some breaking headlines right now from the president. President Trump speaking to reporters outside of the White House. He took questions on both Cuba and on Iran, as well as on the Epstein files. On Epstein, he says he's been fully exonerated. So take from that what you will. He says on Iran that there may or may not be regime change there, and that they're going to continue negotiating. We know that they're going to meet again on Monday, but he says Iran isn't saying the golden words, which is no nuclear weapon. We know they don't want to export any of their enriched uranium. On Cuba, he's saying that Marco Rubio, is working on it, that it's a failing nation, but we know that there has been a lot going on with Cuba lately, and President Trump says that they are talking with Cuba, which I think is the big takeaway from those headlines.
And he also mentioning mortgage rates are going down very rapidly. Of course, he likes to see those interest rates coming down. Still ahead, our Muni moment. Construction on New York City's 2nd Avenue subway is stalled yet again unless the federal government unfreezes funds. Now, the MTA is threatening to sue the Trump administration to get those funds flowing. More on that next. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. First up, Jack Dorsey's company Block said it's slashing its workforce by nearly half in a move the company calls a bet on artificial intelligence. Block has heavily invested in AI tools to run more efficiently, including building its own tool called Goose. Block believes many companies will ultimately have to make similar moves due to AI. Still, some analysts have questioned whether companies are genuinely being transformed by AI or simply using it as a convenient rationale for cost cuts they would have made anyway. Meanwhile, Duolingo shares are plunging after the company said its drive to gain subscribers would mean slower earnings growth and narrower profit margins in the short term. The firm said it would step up investment in AI and sacrifice some degree of monetization in order to accelerate user growth and engagement. The goal being doubling the current number of daily active users to 100 million in 2028. And finally, Zscaler is falling after its second quarter results weren't seen as strong enough to reverse recent negative sentiment surrounding software companies. The company did, however, provide an outlook for the third quarter that topped the average analyst estimate. Vital Knowledge says it's not clear why the stock is getting hit on the report, other than people were hoping for more. Those are your midday movers. I'm Nora Melinda.
Thanks, Nora. Well, time now for our Muni moment. The New York City MTA is threatening to sue the U.S. government unless it unfreezes funds for the 2nd Avenue subway. The MTA CEO saying this week, quote, "We have sent the letter to the feds, just putting them on notice that, honestly, time is up." Bloomberg reporter Michelle Caskey has been covering this story. She joins us now on set here in New York. So this $60 million, if they can't get it from the federal government, does that mean that this subway expansion project is just stalled, or are there other ways to get the money?
It definitely would be at risk. The federal government has promised almost half of the funding for this total $7 billion project. And what the MTA is saying is, look, for the past few months now, we've been waiting on $60 million. We really need it in order to advance the project and to enter into a brand new contract.
You've been covering this for a long time. It feels like the 2nd Avenue subway, it's something that New Yorkers always know is like a project that was, always in the works, but is never actually going to get done.
It's our big dig.
Yeah, is this just like another snarl in that broader story?
Yeah, this project has definitely had a lot. 2nd Avenue subway has had a lot of drama. New Yorkers waited for decades to finally get the first phase of the 2nd Avenue subway, which goes from Midtown all the way up to 96th Street on the Upper East Side. And now this second phase would be extending it from 96 all the way to 125th Street. So it would serve East Harlem. This is a community that has really is in need of more transit service, subway service. And the MTA is saying, look, we need $60 million to really keep that extension project going.
So why does the federal government continually halt funds to New York, whether it's for the Gateway Project or for this? Is it to punish voters that they see as, a Democratic bloc, or is it so that they can have a fight with the mayor, that Donald Trump calls a communist?
Mm-hmm.
Are they actually trying to save money? Do they hate public transportation?
It's a big question mark for New Yorkers. Why is this going on? We're talking about projects that are vital. They're needed for not just New York City, but the New York City region, and for the economy, the business community. They want these projects done. So the federal government said, the Trump administration says, look, we are reviewing your contracting hiring process, and
because they think there's DEI involved.
Yeah, what they're saying is Trump administration has a new rule that says, look, you can't make it mandatory, or what they're doing is the federal government is saying, look, we're prohibiting you from implementing mandatory contracting hiring based on sex and race. The federal government is saying no more of that. What the MTA and also the Gateway Project, which is the new Hudson Rail Tunnel connecting New Jersey and Manhattan, what those two agencies have said is to the federal government, no problem. And they've handed, over the past several months, have handed in documents showing the federal government that they are in compliance with this new rule, but still the money is sitting there.
We'll have to watch this. Michelle, we'll have you back soon. Michelle's Bloomberg Caskey, thank you. Still ahead, the final spread. The week ahead, the U.S. jobs report on deck. This is Bloomberg Real Yield.
I'm Matt Miller alongside Emily Grafeo. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. Saturday, the Berkshire Hathaway annual report. Monday, Bloomberg sits down with JPMorgan CEO Jamie Dimon. Plus, we get global manufacturing PMIs. Tuesday, Bloomberg Invest kicks off. Danny Berger and I will be there for open interest. Plus, we get results from Target, Best Buy, Ross, and more. Wednesday, Apple's product event, US ISM services data will be released as well, plus China's two sessions kicks off, and China's two sessions. Not sure exactly what that is. Thursday, U.S. challenger job cuts and jobless claims. We get those data points, plus ECB President Christine Lagarde is speaking. Friday, U.S. payrolls data is released, and Treasury Secretary Scott Bessent speaks, plus a lot more Fed speak. We get Hammock, we get Paulson, and we get Daly. So there is a lot going on in economics. And speaking of that, we've got our U.S. economist here on set. Stuart Paul of Bloomberg Economics joins us for a deeper look at the upcoming payrolls report. And Stuart, what a fascinating week for labor, because on the one hand, you get some data points out like software job openings, according to Indeed, up 11%. And I think Torsten Slok was putting out some data this morning, or no, it was Nick Colas from DataTrek showing that job seekers are still demanding to work from home. We haven't even gotten back to half of the office population that we had before the pandemic. On the other hand, Jack Dorsey and Block, they're firing half of their workers because of AI. And that was the scare that kind of kicked off the week. So how's it look?
Well, so let's pull apart some of those threads. I think that what we're really seeing in terms of job openings is employer-induced churn in the labor market. We saw a lot of software layoffs already. Now those jobs are reopening. But when you see employer-induced churn, it typically means that there is going to be less wage pressure than when we have worker-induced churn. Immediately in the post-pandemic period, you saw really high quits. You saw a lot of people looking for new jobs at higher wages. Now the turnover that we're seeing in the labor market is coming from the other side. It's coming from employers. So we're not going to see the same wage pressures even when we see these software jobs coming up. When we look at something like what's going on with Block, look, I'm a little bit skeptical that it's all coming from AI. I know that that was his public statement, but when you look at something like real gross revenue per employee relative to their pre-pandemic period, or relative to about 4 years ago, real gross revenue per employee at Block is down by about half. And you see that when you look at real gross revenue per employee at a lot of the companies that are making high-profile layoffs. So again, I think that we're going to continue to see employer-induced churn in the labor market, and that's just going to put downward pressure on wages and downward pressure on income growth.
Just very quickly, what are you expecting for next week? 20 seconds.
Consensus is looking for about 60,000 jobs. I think that they're way overestimated. I think that they're underestimating the risk of a major downside surprise. I wouldn't be surprised if we even saw a negative print because of how cold it was in late January and early February. That's going to really gut employment in construction. It's really going to gut employment in leisure and hospitality services.
Interesting. The whisper number is 70,000.
I think they're overestimating. They're missing that weather effect, I'm telling you.
Stuart Paul, great having you on the program. Thank you so much for joining us. Stuart Paul there from Bloomberg Economics. Quick programming note, catch our new show, Bloomberg This Weekend. Watch and listen on Bloomberg TV. Well, you can watch on Bloomberg TV, listen on Bloomberg Radio. The Bloomberg Business app gives you both options, Saturday and Sunday at 7 a.m. New York time. Emily, thank you so much for joining us. This has been Real Yield.